No, I don't think so. I noticed, reviewing it last night, that there was one little element of contradiction. At one stage I said, you can't call these events to within a few months. And at another point I said, history says that when you reach this level of craziness, the market tends to break within a few months rather than a few years. And I think, with hindsight, the market started to get distinctly weaker about 10 months after we talked. So that's a few months plus a little bit. And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1001 to 3000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. So this is it's almost eerily classic. It's a pattern. It's a very rare pattern. And we have been checking off this list all year. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips. The Russell has started to weaken much more so even than NASDAQ. I would say clearly more. I did freely admit, not in our conversation, but elsewhere, that I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I had been in Japan, or as I had been in the housing bubble of 2007. I used to think then in terms of near certainties. This time I felt highly likely, but perhaps not nearly certain. Today, I feel it is just about nearly certain now. I think the crazy behavior, the peak of crazy behavior, is behind us. I really do. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight, typically. So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. And it always is. You never, almost never, have a major brokerage house say, the game's over, guys, duck. It doesn't happen. The commercial imperative is overwhelming to stay bullish. It's how you make money. The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level. And of course, it declined very quickly, 50% in 1929. It declined 50% in 3 years in 2000. And the housing market, which was another great American super bubble, went all the way back to trend in 3 years. As I said a year ago, I think they'll do pretty well by selling. I'm sympathetic to how difficult it is to get out entirely out of equities. And I would point out, as I did last year, that there are less overpriced parts of the equity market around the world. In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest. It's also true that the value end of the spectrum, as opposed to the growth end, is about as cheap as it gets. So if you can combine those by buying value stocks outside the US, I would say particularly emerging markets, but there's quite a few countries, Japan, the UK, where the markets are. If they're overpriced, they're only moderately overpriced. The US is not moderately overpriced. It is shockingly overpriced. Personally, as opposed to GMO, in the foundation we have for the protection of the environment, we are indeed short a decent amount of Russell 2000s. So we haven't been hurt in the last year, which is amazing. We're also short about half as much again as in the NASDAQ, which did hurt us, but not sensationally. And the point there is a lot of our money is in venture capital. That's very growthy. We need some hedging. And if we weren't exposed to a large amount of growth stocks, I suspect we would skip the hedging. We would skip going short. In any case, I would never short an individual name. I would only short a broad index. And the indices I would short, if I was up for that, would be the Russell 2000, because they have a high density of flaky companies that aren't making any money, and the NASDAQ, which also has a high percentage of companies not making any earnings at all. What makes the NASDAQ more complicated is that it has these remarkable FANG stocks in it. And that makes life complicated. You know, if you could set your dial for 50 years and throw the key away, that might make some sense. But let me remind you that in 1929, you didn't get back in real terms until about 1954. That's a long wait. In 2000, you didn't get back for 13 years. By modern standards, that's a pretty long wait. And in Japan, which is really the granddaddy of both bubbles, land, and stocks, they are not back to their 1989 peak today. That is a very, very long wait. So if you think you can stand it for 10 or 20 or even 30 years, be my guest. But history says a lot of you will not stand it. A lot of you will become more conservative deep into this kind of correction. We have a relatively humble measure of success, and that is at some future date, if you got out when I said get out, you will be glad. It doesn't mean you won't suffer in the meantime, but at some future date, you will be glad. That worked in Japan. We were very early. But if you'd gotten out when we got out, and you'd suffered as the Japanese market went up, you would still have made and saved a lot of money on the round trip. The same in 2000. We were basically recommending that you ease up on US equities by mid-98. And that was a hell of a rally, and that was brutally painful. But it was still a level where you made tons of money. By 2002, the market was much lower than that. A standard bubble we defined over 20 years, perhaps 25 years ago, as a 2 sigma statistical event. It's just a measure of how much of an outlier you are. So you have a historic, you have a price series of the S&P. You can calculate a trend. Statistics 101 is not difficult. And you can work out how far away from trend you are. And a 2 sigma is the kind of deviation that should occur every 44 years. And because we're a little wilder and less efficient than we should be, it occurs every 35 years. It's not bad. Every 35 years. It was a little closer than I expected back then. But every 35 years feels about right. 1 a career, twice a lifetime. That feels like a pretty decent definition of a bubble. And a 3 sigma should occur every 100 years. Now we, as I like to say, we do crazy pretty well as a species. So they occur much more, 2 or 3 times more often than they should. They're out of kilter much more than 2 sigma. So 2 sigma, you can have some fairly standard bubbles. They give you a certain amount of pain, 30, 40, 50% pain. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had. Some bubbles are very specialized to US growth stocks, like 2000. And they hurt. There is a wealth effect. People lose money. They pull back on their spending. But they don't hurt anywhere near as much as when you combine that with a housing bubble. So in 2008, where we had the only housing bubble in American history, that burst and the stock market came down 50% in sympathy. Then you're talking serious damage to the economy through the income effect. Because this time we have, as a multiple of family income, US housing suddenly is more overpriced than it was ever in the housing bubble of 2006 to 2008. And they got there this last year since we last spoke. The biggest increase, 20%, that the US housing market index has ever had has taken it to a new high. And they are, in the US, still much cheaper than Canada, Australia, New Zealand, London, Paris, etc. So that is a global event that could cause enormous pain. So we have a housing problem, we have a stock market bubble like 2000, we have overpriced commodities, and we have, of course, the lowest real rates in the history of man. Absolutely useless.